I think you're starting and then I'm starting on slide 12, so
Yep,
I'm ready
yeah.
for
Oh no,
that.
I just don't know if should
You want
we,
to introduce yourselves?
well, introduce, so hello everybody. We're so glad to have everybody here for this presentation. I am Stephanie Rowe. I am your current LRCFT Secretary Treasurer, and I'm also our union's voting member on the Insurance Review Committee.
Hi, everybody. I'm Katie Carberry, and I am a SCC LRCFT college rep.
Hey, I'm Rebecca Goodchild. I'm City College's LRCFT VP. And just a couple quick things before we get started. If you want captioning, you can start that. You can click on captioning in the bottom bar. We have a live captioner here, so it should be a bit more accurate than the auto captions from Zoom. And of course, hopefully you can see that we have an ASL interpreter as well.
Sounds good. So we're going to go through today and talk about some of the changes in the health insurance plan for 2026 and some of the things to look forward to possibly switching plans from an HMO to a high deductible. So our agenda today is to go over the insurance changes and then talk specifically about the high deductible health plans and the corresponding HSA. And then Katie and I will go over those. We're going to do some cost comparisons between the high deductible plans for Kaiser and Sutter. We're not going over that for Western Health because Western Health, we'll look at that just in the insurance change. Actually, no, we have a slide on Western Health too. And then we'll talk about there are some potential tax issues with an HSA plan. We'll talk a little bit about part-timers, retirement. Unfortunately, the district still has not posted what's going on with our retirement benefits. So unfortunately, we do not have updated information on that. The message I've gotten, and I know some of our faculty have reached out to them, is that they're still working on it. So unfortunately, the district is a little bit behind on that. So what we're going to do is we're going to take a break in between talking about the insurance changes and the high deductible plans. And then we'll take some questions. Or if you type questions in the chat, Rebecca is here to answer your questions in real time. But Katie and I are not going to look at the chat while we're going. So the big thing here is if so full-timers got the email, part-timers did not. So I apologize that my email, I said the email that went out that week, I realized it didn't go out to part-timers. Um, part-timers did not get that email yet because part-time healthcare enrollment is the month before the semester starts. So then you'll get the new information. Um, so HMO coverage is currently very high. And unfortunately, they keep raising it. Kaiser, initially, when we did the um, first IRC meeting came in and Kaiser wanted to charge an additional 20, increase it by 26%. Their initial was only at 20%. So it was still a huge, huge jump. Um, Kaiser was blaming the increase based upon our usage, and that's typically how their justification for the increases are is based upon how much money we actually how much it actually costs the insurance company for us using the benefits. So the more we use the benefits, the more they want to charge us. So it's kind of a double standard because you have health insurance to use it, but then they penalize us for using it. Um, we were able to negotiate during this summer when we do our COLA retro discussion, contributing an additional $67 to our contribution for coverage. So we were at 1535 a month, and so you'll start seeing starting in January, it's going to go up to 1602 a month. So if you look at how much Kaiser is charging compared to how much we are covering, so the contribution is still covering about 65%. So it's about 65-35 is what's being paid by employees. So it's still not a good ratio, but there's that. Um, when it comes to putting money towards the contribution, we don't put a lot of money towards the contribution. One, not every faculty employee is actually using health benefits. And the more money that we put towards the contribution means less money going towards salary schedules. Because of how we are in a bucket system and how we have designated money to be able to distribute how we want to use it. It's usually been more of a focus to get the money on the salary schedule as that affects our retirement, whereas the money for benefits doesn't go towards retirement. So this is some of the dilemma as to why we do not contribute even more towards our monthly premiums is because if we did, that's less money on your salary schedules. And most most faculty are of the mind to increase salary schedules as much as possible. So on the IRC, there's 6 voting members, so each bargaining unit has a voting member on to decide what plans that we are going to choose for the next year. And even though we're the largest bargaining unit, we still only get 1 vote in the district. So there isn't, unless, 1 vote, if I vote no for something, it's not enough to cancel something. We have to have, I think, 3 people to vote no in order to have something not pass. But this year, everybody in the room was pretty much in line with making sure that we try to get the best plans possible from what was actually being offered. So this is the new premiums for our HMO plans. And Sutter, so the rates did go down. We did, like in my email that I sent out to everybody, when we went back to Epic and said try to do a single carrier instead of having multiple carriers, Kaiser and Sutter did decrease their initial projections. So we did get a little bit of a decrease, but still Kaiser coming in now monthly at $2,600. And where our monthly contribution towards that is only 1602, meaning the monthly premium now for Kaiser is going to be $1,000 a month, and Sutter is now up to 519. Western Health is still our best bargain for an HMO plan where it's only going to be $40 basically a month. And then some people are on the DHMO plan, and that's a little bit cheaper, but there's some qualifications to be on the DHMO plan, but that's at $650. So these are the HMO plans that are available, and the premiums that are going to start in our January paycheck in 2026. So you're not going to see it. You're not going to see it until January because we're still under the 2025 plan. So that increase, like I said, was pretty significant, where last year the Kaiser HMO went up significantly too. It went up by $400, and it's going up approximately another $400 this year. Sutter is going up, is almost double what it was last year, and Western Health is technically double too, but it's still a much smaller amount. Um, so the HMO plans, we're technically being outpriced from what um, we're being offered. I know many people are talking, try to think that Epic is the problem, and Epic does what we tell them to do, and they go out and try to get us the best rates. Epic doesn't get a bonus for keeping us on these plans. So I know some people think that Epic gets a kickback if we stay on these plans. So that is not the truth. Um, and some people talk about going to CalPERS and being part of one of those larger community type of health plans. Even if we did do that, we would Kaiser's like, because Kaiser is a lot cheaper because those plans are public and how much the rates are being charged for their members. Even if we did go on CalPERS, if they accepted us, um, we would be grandfathered in with Kaiser. Our rate would not go down. So unfortunately, these are the rates that we have, and we continue to try to bring them down, but the HMO plans we're being priced out of. So the alternative is to go to a high deductible plan. So a high deductible plan is similar to an HMO, where a traditional HMO, but the difference is instead of paying a copay, you are paying the insurance rate until you meet your deductible. But the doctors are the same, the approved, the medicine the same. So everything about an HMO with the actual care that you receive, nothing is different. It's exactly the same type of plan. It's just how you pay for it is different. And the reason why high deductible plans are a little bit cheaper is because people go to the doctor less. This is the theory from the insurance companies that people go to the doctor less with a high deductible because of that out-of-pocket cost. When you go to the doctor and not just having a copay. So we'll talk about that out-of-pocket cost up until the deductible in a few slides. But each of our carriers all offer high deductible plans, and they're they are an HMO just like the traditional HMOs, but you just pay a little bit differently. So the minimum deductible for a high deductible plan is set by the IRS. And the carriers basically can choose to offer a plan at that minimum, or they offer a plan above the minimum in order to have other benefits with because the biggest thing with a high deductible plan is what happens after you meet the deductible. So most of our plans have just one thing you pay for after you meet the high deductible. So the IRS for 2026, the minimum for a high deductible plan is $3,400 for family plans and $1,700 for individual plans. You'll see that none of our carriers are at the minimum. They're all above in some sort. And that was in order to get the best benefits. But so what that means is once you hit that deductible, then there are certain things that you only have to pay for after you meet that deductible. And then those certain things you pay for, then there's also a cap of how much out of pocket in total you will pay for the plan. So we'll show you some comparisons as to how much out of pocket you can pay in total for a high deductible compared to a traditional HMO. And the high deductible plan is always going to be cheaper in total, and you're getting the exact same health care. I know people think like, what's the catch? What's the catch? The catch is insurance companies think people are going to use it less because of that initial out-of-pocket cost up until you meet your deductible. Oh, so I'm getting ahead of my slides. So, like I said, um, before you meet the deductible, you pay the full cost. So, like my doctor, to go see my doctor for regular annual physical would be like $280. And that's the insurance, negotiated insurance rate. So I pay that rate. And, if I pay if for any other medicine I have, any other doctors I have, I pay that um, full negotiated rate that the insurance company would pay up
Real quick,
until,
sorry, Stephanie, who
yeah,
is the current ASL interpreter?
I don't know, she dropped off.
Right, I need to.
I didn't drop off. We switch
Oh,
every 15 minutes. It's Carol now.
oh, thank you.
Okay,
Thank you.
thank you. I just need to highlight the person, so
I'm
let's
here.
see. Okay, it's just the way I have my screen set up.
We
What
got to
is your
find you,
Yeah, what's your first name and your
Carol.
Carol?
It's under ASL/English interpreter Carol.
Starts with an
Gotcha.
asterisk.
There
Okay,
we go.
there we go. You
Thank
want to make
you.
sure you're highlighted. Thanks,
I'm gonna
thanks,
actually
Rebecca.
highlight both of you, I think.
Yes, please do that. Highlight them both.
Uh, okay, where's the other one? I'll figure it out. Yeah, oh, got it.
Sydney,
Oh,
Sydney.
yeah, sorry, keep going.
Okay.
Sorry.
So, and then after the deductible, you pay usually $0. So, like for me, like last year, the deductible for Sutter was $1,600. I met that deductible because, I've had some issues like cancer and everything like that. So I have to go to the doctor. And so I met my deductible by May. Since May, I pay nothing, nothing. Like for everything. So this was the same in when the year before the deductible was like 1,500. I ended up having two surgeries and like MRIs and a bunch of procedures, and I met my deductible, so I paid $0. And if I was on an HMO, I would have to still pay the copays and any other fees that would come along with that additional care. But a high deductible plan, it's $0. So the only thing on Kaiser and Sutter in 2026 that you have to pay for after you meet the deductible is that hospital admission. Kaiser, you pay $100 and Sutter, you pay $50. So that it's not every single day, it's just the admission. And then that's all you pay after your deductible. So you can have a surgery and not have to pay for it, which is what I did. Western Health, after you meet the high deductible, you still have to pay the prescription copays. But so that's the beauty of a high deductible plan is that if you do go to the doctor and have to go to the doctor, then you and you're not paying a premium every single month and paying copays for every time you go to the doctor or have a medical treatment. So I've been on a high deductible since I joined the district or became full time, and it's saved me a lot of money. So with a high deductible plan comes a health savings account. So if you're on a traditional HMO, you have the ability to go get a FSA, a federal savings account. So the FSA works different than the HSA. The FSA, when you're on a traditional HMO, you have to sit there and try to predict how much out of pocket medical expenses that you're going to have. And it'll be taken out of your pre-tax, and you then make claims against it to spend the FSA money. But after the year is up, if you do not use all the money that you put on your FSA, you lose it. So there's kind of a gamble with a traditional HMO with the FSA plan account to make sure that you're not you don't overestimate how much you're going to spend, and to get that pre-tax benefit. An HSA plan, which is only available with a high deductible healthcare plan, lets you set aside pre-tax money, and so you can contribute yourself pre-tax, and the district is going to be contributing some money too. We'll talk about that in a little bit. But this all goes into an HSA account, and it earns interest, which has some tax implications for state of California, but it earns interest and it's your money. If you do not use it all in the current year, it just rolls over. It's just continuous. And when you retire, it's still your money. Now, you have to, when you retire, that money doesn't get to just be cashed out. You can use it after you retire for health benefits in the future after you retire, but it's still your money. So that's what's great about an HSA account compared to a traditional HMO and an FSA account. So it carries over it if you don't spend it, and it's yours when you retire. But you have to have a high deductible plan to be able to do an HSA. If you're on a traditional HMO, the only option for pre-tax qualified medical expenses is an FSA account. So the health savings account is great. So the district this year is to part of what happened in the IRC is I basically demanded that the district do something because of the atrocious increase in costs. If you want to really know how I responded, come to our first Fridays, and I will let you know what I really said. But so the district's plan was to give $1,500 a year, so $3,000 in total for this is unfortunately only for full-time faculty, not for part-time faculty, to go towards the HSA account, because the district is also trying to get people to move to the high deductible plans since it's cheaper. Though there's some caveats, okay? So not everyone is eligible for an HSA contribution, okay? Now, you can be eligible to have an HSA account and put your own money in it, but you're not always eligible for that contribution. So you're not eligible for the contribution if you have other health coverage outside of the high deductible plan, okay? So what does it mean by other health coverage? So if you or your spouse, if you have family coverage, have a high deductible coverage, you can't have other health coverage. So your spouse can't have their own plan, which is not a high deductible. So if you both have your individual plans, you can't get that eligibility for that contribution for the high deductible plan. You can't have an FSA. If you have a high deductible, you can't get an FSA anyways. But so that other health coverage is really key in what limits who can get this contribution for the HSA, okay? So you can't have both spouses on two different plans. You have to be all on the high deductible plan or not. Katie, did I cover that enough?
I think so.
Okay. I wanted to make sure, because we wanted to bring this caveat before we talk about the monies that could be saved by going to a high deductible plan, because we want to make sure you realize that there is a caveat. There is a limitation to be able to get this benefit. So let's go into a little bit more detail. So health insurance that covers you, even if provided by somebody else. So that's other health coverage. So if your spouse is covering you and you want a high deductible plan, you cannot get that contribution. If you participate in Medicare, you cannot contribute to an HSA plan. If you have TRICARE benefits, which is military benefits, you cannot contribute to an HSA plan. So if you have VA medical services, that'll disqualify you from making HSA contributions. Unless receiving treatment for a service-connected disability. And of course, you can't have an FSA and an HSA. I actually tried that when I first started, but yeah, it doesn't work. You have to have an HSA or an FSA. FSA is for traditional HMOs, HSA is for high deductibles. So if you have a question about your eligibility, or you have a more complex family situation, because sometimes when it comes to having dependents also can throw a wrench into this. Reach out to HR. Our employee benefits is Nicole Keller. So definitely reach out to her. I'm not the wherewithal of who would be qualified or not qualified. I'm just giving you the basic overrun of what happens. So before we switch on to the total cost, when it comes to the high deductible plan, the monthly premium for Kaiser is going to be $21 because it's the high deductible plan is $1,623. Our contribution is $1,602. Sutter used to be last year was $26 a month. Now, unfortunately, it has gone up to $244. But we were able to negotiate, luckily, because initially Sutter High Deductible wanted us to do a co-insurance.
At your front door.
I'm sorry, co-insurance after meeting the high deductible, and that would have just cost so much money. So we were able to negotiate a lower price and get back to where after meeting the deductible, the only thing you have to pay for is going to be the the hospital admission. But you still, right now, we have to pay a premium now for Sutter. Western Health is their monthly premium is coming in at $13.92. So that is $200 less than our monthly contribution. So because their premium is less than the monthly contribution, the district also puts an additional $100 a month towards the HSA account for individuals and $150 a month for families. And that's 12 months. So it's $1,200 and I can't, even though I'm an accountant, I need a calculator. And that's $1,800 for family. And that's not including the additional $1,500. Okay, so this is separate from that additional contribution of $1,500. So Western Health High Deductible is like a winner. So there's no premium for Western Health, and additionally you get additional monies. Okay, so the thing is, part-time faculty who are on high deductibles can have an HSA account. You just can't get the district contribution right now.
Rebecca, could you spotlight the other interpreter now, please?
Yeah, I did it. I just took off Stephanie though. I'll put her back on.
No problem. So you can contribute to an HSA, but you just can't get the district contribution. So I did say words right. So that's something that we're looking to try to negotiate in the contract negotiations next spring. Okay, with that, I'm going to send it over to Katie. Right? This is slide 12, right, Katie?
Yeah.
Okay.
Now I think I need to be spotlighted. Also, I think you're going to have to keep sharing the slides for me, Stephanie, because when I tried to share them, I could not do it. So I guess I'll just have to ask you to move the slides forward for me. Sorry about that. Okay, so we are on to talking a little bit more about HSAs and how they work with the high deductible plans. Stephanie, did you already go over this slide? I'm sorry. No. Okay, so basically, when you have a high deductible health plan for a given tax year for the whole year, then this is going to make you eligible to put up to a certain amount of money into the HSA. And part of the money that goes into the HSA that counts towards this limit is what your employer contributes. So if you get any money through Los Rios that they put in there, that is part of the limit. But if you want to add additional money beyond what the district is contributing, you can also do that through payroll, or you can actually technically do it directly outside of payroll if you want to, up to these limits shown here. So if you have a high deductible plan exclusively, and that's your coverage, and it's a single plan, then you can contribute up to $4,400 in the HSA for that year. And if you have family coverage, then you can contribute up to this $87.50 for that year. These are pretty high amounts, and you'll notice if you look over the deductibles for these plans that these amounts are higher than the deductibles for the plans. So what this means is that you have the option to put into the HSA the entire amount of the deductible for your plan. And then the idea is that you would be able to use that money from the HSA to pay for your medical costs until you meet the deductible. And as Stephanie mentioned, if there's money left over at the end of the year, it just carries over, it rolls over forever pretty much. You just keep it in there and use it in the future for your medical costs in a future year. That's one of the things that makes the HSA, in my experience, better than the FSA, because you don't have to worry about it expiring. Okay, I think we can go to the next slide. Okay, so once the money is in the HSA, people have questions like, what can this money actually be spent on? What counts as medical costs? This is any cost that you or your tax dependents have. It's like if you have people who are your dependents, you can use the HSA money to pay for the medical costs of them and yourself. And that includes like your medical costs, like things that we all know are medical costs, like going to the doctor, going to the hospital, prescriptions that are prescribed to you. You can also use the HSA money for dental care and orthodontist care. You can also use it for vision care, like if you go to the eye doctor or get new prescription glasses or contacts. And then you can also use it for mental health care if it is, to treat a diagnosed mental health condition. And you can also use it for over-the-counter expenses of some kinds. Not all over-the-counter expenses, not like whatever you want, but there's a list of over-the-counter medical products that you're allowed to use this money on. And if you want to see the kinds of things that includes, there is an IRS publication that I believe the Los Rios Benefit website has a link to. I just like to look at hsastore.com, which is an online store that sells things that are all eligible for being purchased with an HSA. You don't necessarily need to buy anything from there, but that will let you see the kinds of things that you could buy. It's like Band-Aids and some other health-related products. Maybe you want to buy a first aid kit or something like that. There is a penalty for taking the money out of the HSA or using it to buy things that are not qualified medical expenses, or if you use it to buy medical expenses that are not for your own dependent. Like you can't just go buy something from Amazon that's not a medical item. The HSA account is just like a bank account, and they give you a debit card. And so you just want to be careful not to use that debit card to buy things that are not approved medical expenses, because there can be tax consequences for that. You also want to be careful not to use the money to pay for medical expenses of someone who is not your actual, dependent. Like don't use it to pay for your friend's medical expenses or something like that. In the actual slides, there's a link to the IRS guidelines in the notes on the slides as well, that on one of these slides that tells you more details on what that type of medical expenses can include. Okay, Stephanie, next slide.
I just want to say one other thing too, like
Oh, sure.
some of the other things you can for chiropractors. For like I used it for Massage Envy, like to get monthly massages. Like you can, like I paid for the subscription plan for Massage Envy to get massages. That qualified for a medical for the HSA too. So there's lots of things that you can pay with the HSA. That's why putting more money than just your deductible is great because you can use it for a variety of things that is pre-tax and you get a double tax benefit for using HSA money.
Right. So there are quite a few different things, and there are many resources online to look at what all of those things are, but it's pretty broad. So if you think something is probably a medical cost, like if a doctor is telling you that you need it, or a dentist is telling you that you need it, then it is probably something that you can pay for with this. In general, you would want to double check, but it usually is. Okay, so let's go on. Okay, so the next 3 slides are going to be a comparison for each of the carriers, Kaiser, Sutter, and WHA, between the high deductible and the HMO plan, just in terms of the financial cost analysis if you were to choose between these 2 plans. And we're doing this because we know a lot of people want to stick with the same carrier. Like if you're on Kaiser, you might want to keep Kaiser. If you're on Sutter, you might want to keep Sutter, but you might want to have an idea of how the high deductible plan and the HMO plan compare in terms of like what your ultimate costs might be. So for the Kaiser HMO, it is going to cost for the premium cost over $1,000 a month. It says $1,057.96 per month. That is for individual or family. We do not have different premium rates here for individual versus family coverage. So that means that if you have the Kaiser HMO, you are going to be paying over $12,000 a year for this healthcare coverage. And then in addition to that, you would have to pay any copays that you owe because when you're on the HMO, you have to pay copays for prescriptions and when you go to the doctor and things like that. That is a very high amount of money. So on the other hand, if you have the Kaiser high deductible plan, you are eligible for the HSA, which most people are, but like we've talked about, some people aren't. But if you're eligible to contribute to an HSA during this plan year, and you're a full-time faculty member, then the district is going to give you $1,500 in the HSA. They say they'll put that in February 2026. So you'll have that $1,500, and then your premium cost is only going to be $253, which is almost nothing. So it's very low premium cost. With the high deductible plan, your deductible, if you have the individual coverage, is going to be $2,600, and your deductible, if you have the family coverage, is going to be $5,200. However, there's also, for family coverage, a separate deductible for an individual within the family. So any individual within your family, they have their own deductible that's $3,400. What that means is that, like, say you have a family with 4 people, the deductible for your whole family is $5,200, but for each individual person, it's $3,400. So if one of your family members has a lot of medical expenses, then once that individual family member reaches $3,400, that individual family member doesn't have additional costs beyond hospital admissions. And if you're an individual, and you're on your own plan, not a family plan, once you, as an individual, have paid $2,600, you don't have additional costs either beyond hospital admissions. The hospital admissions are $100 per admission after you meet the deductible on this plan. So as Heiko was kind of alluding to in the chat, it's very difficult to see how you would go much beyond the deductible on this plan, even though the out-of-pocket maximum for an individual is $3,400. Because once you reach the $2,600 deductible, all you have to pay for is $100 if you go to the hospital and you're admitted. So you would have to be admitted to the hospital a lot of times in the year before you would get from $2,600 to $3,400. I guess that's 8. Is that right? 8 hospital admissions. That's quite a bit. Now that could happen. Someone was saying in the chat, how could this happen that we would meet these out-of-pocket maximums? Well, I guess if you went to the hospital 8 times, that's how it would happen. So that is a thing that could technically happen, but it's very unlikely. Because everything else besides the hospital admissions is included for free after you meet the deductible. Okay, so the takeaway of this is really that, and we've gone back and forth on how to phrase this, but it really is that financially the high deductible plan is better because the most you could pay on the high deductible plan for a family is $5,803, like $5,803. That's the maximum out-of-pocket maximum for family plus the premiums. Whereas if you go on the HMO, you're going to pay over $12,000 no matter what. So financially, you cannot come out ahead on the HMO. There is no way that that can happen. Even in the worst case scenario where you use the maximum amount of health coverage on the high deductible plan, you will still be saving thousands of dollars if you are on that plan compared to being on the HMO. Okay.
I know we have I don't know. Do you want to take a question?
Well, I
Brenda?
don't know how we want. I think it might be a little bit better if we can finish these comparisons and then
Yeah.
do the questions.
Okay,
Or you
so-
can type your question in the chat and Rebecca and Stephanie might be able to answer it while
So-
I'm talking.
Yeah, so I'm actually answering a few, and the ones that are more complicated or I don't know the answer, I'm just copying to another sheet that we can kind of address at the end. Okay. Because
Okay.
some of them are just a little bit more nuanced.
Excuse me.
I can look through them too when I'm done with this part. So let's go on to the Sutter comparison. Okay, so if you want to be on Sutter and you're trying to choose between the high deductible and the HMO plans, if you're on the HMO, the amount you're going to pay is $519 a month. And then that adds up to over $6,000 a year. Plus you have to pay the copays because on an HMO you owe copays as you go for prescriptions and visiting the doctor and that kind of thing. On the other hand, if you're on the Sutter high deductible plan and you're a full-time faculty member, you're going to get this $1,500 district contribution to the HSA, unless you're in a rare situation where you're not eligible for an HSA. And the premium cost for the Sutter high deductible plan is $2,934. So you'll be paying that $2,934, but that would be offset by this $1,500 district contribution to the HSA. Then you have to pay the deductible as you go. So for your healthcare, you are going to have to pay for it until you meet the deductible. For an individual on an individual plan, that is $1,700. For a family on the family plan, that is $3,400. And Sutter's is different than Kaiser's in that the individual deductible within a family, I think we lost the ASL interpreter. Oh, there we go. Thank you, Rebecca. So Sutter is different than Kaiser because for Sutter, the deductible for an individual within the family is the same as the overall family deductible. So once one person in your family meets that $3,400 deductible, your whole family has met the deductible. And just like with Kaiser, the only thing you have to pay for on Sutter high deductible plan after you meet the deductible is hospital admission. Sutter only charges $50 for that instead of $100. So when you look at this, the cost of the high deductible plan is the $2,900 premium minus your amount you might have to pay for the deductible, plus the $50 admission after meeting the deductible. That's kind of like the maximum amount you could end up paying. If you look at this overall, the cost of the Sutter high deductible premiums plus the deductible costs minus the HSA contributions is still less than the HMO premiums, because with the HMO, you have to pay $6,229. That is the minimum amount that you can pay on the on the HMO, excuse me. That's like if you never go to the doctor. Whereas if you add up the premiums of the high deductible plan plus the deductible and subtract the HSA contribution, it's less than that. Okay, let's do WHA. All right, so for WHA, this is maybe the one you're going to want to focus on if you really want to find a way to reduce healthcare costs, because with the HMO, it is only $38 a month. And that's only $466 a year for the HMO plus copays. So if you want to be on an HMO and you're flexible about which insurance company you have, WHA might be the one for you, because it has a pretty reasonable premium. And then you would be able to just go through the year paying paying copays for any care you have. With the Western Health Advantage high deductible plan, though, they have a monthly contribution that the district is going to give you to this plan, in addition to the one-time district contribution. And this is all for full-time faculty only. They don't give these HSA contribution amounts to part-time faculty, unfortunately. We tried to get them to do that, but they said no, is my understanding. I wasn't there. Stephanie agrees. They said no, so we tried. So if you're a full-time faculty member, though, then if you're on the high deductible Western Health Advantage plan, every month, if you're on individual coverage, they'll put $100 in the HSA, or $150 if you're on the family coverage, they'll put that in the HSA. Plus, in addition to that, they will give you the $1,500 contribution in February. So you're going to be getting a bunch of money in the HSA. If you're on the individual plan, you would get $2,700 during the year from the district in the HSA. And if you're on the family plan, it would be $3,300. Then the deductible for these high deductible plans is $1,800 for the individual plan, and it's $3,400 for an individual within a family, and it's $3,600 for the whole family. The big difference to note between the Western Health Advantage high deductible plan and the Kaiser and Sutter ones is that after you meet the deductible in Western Health Advantage, you still have to pay prescription copays. So whereas on Kaiser and Sutter, you still had to pay hospital admissions, with Western Health Advantage, you're still paying prescription copays, which may be $10, $20, $30, whatever it is for the particular medication that you're on. Now, because of this, if you had lots and lots and lots of prescriptions in your family, it is possible you would end up paying a little bit more than the deductible, or maybe even a lot more. Maybe you have a large family where people take many, many prescriptions, and some of the prescriptions are name brand and have the higher copays. You would still have to pay for those after meeting the deductible until you got to the out-of-pocket max. So it is technically possible to get to the out-of-pocket max on this plan, but the situation that would cause that to happen would be taking lots and lots of prescription medications. When we look at this and compare the HSA high deductible plan to the HMO, we see that the district HSA contributions will cover the full deductible cost on the high deductible plan for individuals, and will cover almost the full cost for family coverage. But because the HMO cost for Western Health Advantage is pretty low, if you really don't want to deal with the high deductible plan, or if you just prefer an HMO for whatever reason, this could be, it could be good for you either way. All right. So what we have next is a section that is a little bit more about how the HSA is and how it works. So if you choose to go on the high deductible plan and you're eligible for the HSA because you don't have some special situation that makes you ineligible, you can take the money that is in there, the money the district put in, or any money that you may choose to put in yourself, and spend it on your medical costs. How does this work? People sometimes wonder. The HSA is kind of similar to a bank account. It's an account. You go on fidelity.com, you can log into it and see how much money is there. And you have the option to receive a debit card to spend the money, just like you do with a regular bank account. Or if you don't want to use the debit card because that's just not how you prefer to do things, maybe you want to pay for your medical costs with like a check or whatever, you can pay for the costs that way and then reimburse yourself later from the health savings account. Meaning, by reimburse, I just mean you transfer the money out of that account back into your real bank account. If you put a bunch of money in there and you have some that builds up because it rolled over from previous years or whatever, you can invest the money as well because it's on Fidelity. So they let you choose to invest the money if you want to. Kind of like you could invest the money in your 403B or 457. It's similar to that. But you do not have to invest the money. That is just one option that they offer. You'll see when you go to sign up for this HSA account and in some of the literature that the healthcare plans and the district provide that they use the phrase triple tax advantaged. That is really applicable to federal taxes only because California does still tax earnings in HSAs and taxes, treats the payroll contributions as after tax for California purposes. But for federal tax purposes, if you make payroll contributions to the HSA, it's pre-tax. And you can also put money in yourself separately, and that is tax deductible for federal taxes. If you do invest the money and the money is earned within the account, you don't have to pay federal taxes on it, on those earnings. And if you take the money out, it's not taxed if you use it for qualified medical expenses. So that's what they mean by triple tax advantage. They mean you can put the money in pre-tax, the earnings don't have taxes, and then when you take it out, there's no taxes on that either. Federal taxes anyway. But for the California taxes, it's not quite that way. So that's just something to keep in mind when you see the term triple tax advantage. Okay, now let's look at this. This is a screenshot that I took of some of the Fidelity HSA literature. So this is like an example that they have. So they say, for example, if you contribute before taxes $3,000 in their little example, because that's pre-tax, your take-home pay isn't going to be $3,000 less for that year. It might be, they say $2,110 less. That depends on your tax bracket and stuff like that. But when you put the money in pre-tax, the amount of money that goes in there is not, that full amount is not deducted from your pay because you're doing it pre-tax. This is similar to if you have like a pre-tax retirement contribution. So then when you use the money for medical care, you're saving money because you didn't have to pay taxes on that. I think that makes sense. Okay, so let's look at an example. Let's say you're a person and you're an individual person on individual health coverage on Kaiser high deductible plan, and you're eligible to make HSA contributions. So you open up the HSA. You have to pay $253 a year for the high deductible plan premiums in 2026, but you're going to receive this $1,500 HSA contribution from the district. And so you could also add additional money. You might say, well, as an individual, I know I'm going to have a lot of medical costs and I want to make sure I can cover it all. So you might decide to contribute $80 a month through payroll, and that would be an extra $960 a year. Then that money is going to be taken out of your paycheck by the district and sent directly to the HSA at Fidelity. It'll just go into there every month. If you wanted to, you can also go to fidelity.com and contribute the money directly. That works kind of in the same way as making like an IRA contribution. You might do that if there was a sudden higher than expected medical costs and you wanted the money to be in there pre-tax. Or you might do that if you want to make sure that you have the full amount that you'll need at the beginning of the year. Then you have the option to do that. If the money that you put in there is invested and it earns, let's say it earns $52 of interest because they have, it earns a little bit of interest when it's just in there in the account. The default thing that it's in is some kind of money market account that pays interest. So let's say you earn $52 of interest, then even though that $52 is federally tax-free, you do have to pay California taxes on it. So if you do your own taxes, when you are filling out the California taxes, there is a question that comes up like, do you have any earnings from an HSA? And you type $52. And that's how that works. Okay, we have one more slide and then it's going to be time for questions. So how will it work? So a lot of people have this question, how is it going to work? How am I going to pay for things And what will I have to pay for exactly on this high deductible plan? So when you're on the high deductible plan, you still pay $0 for things that are considered preventative care. That is like if you get a preventative screening, like if you go get a mammogram or a flu shot or something that is considered preventative, you don't have to pay for that. And the government has a list of what is considered preventative health care that you can go look up if you're not sure. But things that would be preventative care on an HMO are also preventative care on a high deductible plan. So even if you haven't met the deductible, you still don't pay anything for preventative care. But before you meet the deductible, you still have to pay all your other costs at the insurance company's negotiated rate until the deductible is reached. And you can use the HSA money to pay those costs until the deductible is reached. So I like to focus on this because before I went on the high deductible plan, I didn't quite understand it correctly. I thought that I would have to pay the full like sticker price that was advertised to the public for costs before I met the deductible. But actually what happens is that you have to pay the cost that the insurance company has negotiated for that service, which is usually, it's always lower and it's usually a lot lower. So for example, let's say that I'm prescribed a prescription and the pharmacy website says this prescription is $146 without insurance. When I give them my insurance card and they run it through, what happens is that I end up only owing the insurance negotiated rate for that prescription, which is probably something lower. I think this is from a real example that I had. It was $67.13. So that amount, the negotiated amount, that's the amount that I pay before I meet the deductible, not the full sticker price. After I meet the deductible, then I won't have to pay anything. And I see actually there's something we need to fix right here. This is actually Sutter or
Oh, so-
Kaiser.
Yeah, it should be Sutter and Kaiser.
Look at that. I'm fixing it right now. Is it working?
No,
Oh, I just
because I'm in the slideshow.
Okay.
Yeah.
Well, on this, it says you'll still have to pay the RX cost on Sutter and have an RX copay on Kaiser and Western Health Advantage. That's wrong. You'll still have to pay the prescription cost. You'll only have to pay the prescription copay on Western Health Advantage. If you're on Sutter or Kaiser, then you don't have to pay for prescription costs after meeting the deductible. And the reason that that typo is there is that in previous years, you did have to pay for prescriptions on Kaiser after meeting the deductible, but that is no longer true. So I apologize that we didn't correct that. It is now the case that you do not have to pay prescription costs on Kaiser after meeting the deductible. Another example would be like if you went to the doctor, you might see that the doctor's office visit, I think we're switching ASL interpreters. The doctor's office visit.
Hang on.
Okay.
Sorry. I'll get better at this eventually. Okay, let's do. Ta-da! Oh,
Great.
and I have them both on there now.
It's all happening.
Woo!
Okay, so for a doctor's office visit, just like with the prescriptions, there are negotiated prices for all of the healthcare that your insurance company is going to have. So for a doctor's office visit, the price without insurance might be $234, but maybe the insurance company's negotiated rate with that provider is $180.17. So it's that $180.17 that you pay before meeting the deductible. And it's like that for all of the things. There's always going to be an insurance company negotiated rate, and it's usually, can't say it'll always be less, but it's usually less. I've never seen it not be less than the publicly advertised rate. And then after meeting the deductible, going to the doctor is going to cost $0 because you've met the deductible. Okay, so now we're on the question break slide, and it's all time for everybody's questions. I don't even know how we want to manage this. Rebecca, what should we do?
Okay, how about I just throw some at you?
Sure.
Okay, so Can you quickly address the VA healthcares or other ways that you may or may not be ineligible for HSAs?
Address the VA thing.
Yeah, basically, what are the conditions? So, if you're on Medicare, if you are,
Okay, well, let me say something for broadly. The things that make you ineligible to contribute to an HSA during a specific year do not mean that you can't have an HSA at all. And this is something that's tricky. And when people talk about it, it's easy to speak in a way that is wrong. So let me just make sure I was clear. And that Stephanie was clear and that what we wrote was all clear. So, like, I have an HSA right now, and there's money in it, and it's rolled over from previous years. In the future, when I'm on Medicare, because I'm 65 or whatever the age for Medicare will be in the future, I won't be eligible to contribute to the HSA anymore, but I will still be allowed to keep my HSA and the money in it. So the things that make you ineligible to contribute to an HSA don't mean you can't keep the money that is already in it if you were eligible to contribute in previous years. There are a bunch of tax guidelines that describe like when people are ineligible. It says that if you leave your employer, I believe it says you can use the HSA money to pay for COBRA premiums, but not other types of insurance premiums. There is also I put a link way back up in the chat, but there is also some information about when you can use HSA money to pay for Medicare premiums, even though you're not allowed to put money in an HSA when you're on Medicare. If you have money in one, then it seems that you can, at least some of the time, use that money to pay for Medicare premiums. So that is something that I think people would need to really look at and maybe even talk to a tax professional about, because those are unique situations. For the VA thing, the IRS document that I saw said something about, it basically said that there was a requirement that you have a service-connected disability if you want to go to the VA medical care, and also in addition to that, have the HSA. I'm going to copy and paste something into the chat that addresses that. It's this PDF here. But like, again, I don't think that what I am saying about this, I don't think anyone should plan their whole lives on that. So if that is a situation that applies to you, I would definitely check with like someone who's knowledgeable, like a tax person or maybe the benefits office, to make sure that you're correctly understanding whether you're eligible or not.
okay. Okay, cool. Let's see here. Another one. Do you qualify for a high deductible healthcare plan if you have any other health coverage and not just, yeah.
Can you qualify for a high deductible plan if you have any other health coverage? Is that the
Yeah.
question?
Yes.
Okay,
No,
you can sign up for a high deductible health plan.
but you can-
Anybody can do that, but you will not be eligible to put money in an HSA for that year unless you are only covered by the high deductible health plan. So
Okay.
like if you sign up for the high deductible plan, but you're also on an HMO through like a spouse or someone else, or you also have some other type of medical coverage, then you're not exclusively covered by the high deductible health plan. And so that would make it so you can't put the money in the HSA. Stephanie, does that sound right?
Yep. Yeah, you can have the plan, you just can't contribute to an HSA. You can't have the HSA too. So, but I don't know why, if yeah, the dual coverage thing doesn't make any sense to me, but yes. Mhm.
Okay, yeah, cool. I think you talked about this a little bit, but people are probably worried about taxes. So here's a question. I switched to a Sutter high deductible plan last year. I also set up an HSA. I had several big expenses in January, so I transferred money into my HSA from my bank account. How will that work when I report it for my taxes?
So there's a specific thing when you, on your taxes when you are is that asks, did you pay up to the maximum deductible? So there's a place on your taxes. Well, at least well, I'm a professional tax. So when I do professional taxes, I have a place where it says, did you pay up to your maximum? And you can actually say how much you've paid towards your taxes. But if you do your own taxes, it might be different. So
Well, maybe I'm misunderstanding the question. I think what this person is saying is that they contributed money to the HSA outside of payroll, just put it in.
Yeah.
And
Yes.
now they're saying, like how will this affect their taxes? So basically, maybe what yeah, like Stephanie maybe is saying it from a different perspective. Maybe we're saying the same thing. But when you do your taxes, the money that you put into the HSA yourself is deductible.
but you have to enter it in. You have to
And
say
they,
how
yeah,
you report how much you put in. And then so unlike doing it through payroll, which is already pre-tax and already your taxable income is already reduced by how much you do through payroll. It's only if you pay additionally by yourself, it's only on there's only one place on the tax form, and then it will reduce your AGI.
right. And
Your adjustable gross, so it'll reduce your adjustable gross income, which means it'll be pre-taxable.
yes.
It's a good plug. Stephanie runs her own tax business. If you want her to do it for you.
I found it not hard to do in the exact same situation. And I believe that Fidelity gives you the information that you need to type in there.
Yeah, I think
See
they
how much
probably
you
give you a
contributed.
1099. I don't know what the letter is. But
Yeah,
they,
it's called something else.
Intermisc.
yeah, there's some other form, but they give you a tax form that you enter in on your taxes.
Yeah, plus they give you a statement that you can look at and it'll say you contributed this amount or whatever. You can type that in to the taxes and get the deduction. You just have to make sure, everybody, that if you put money in the HSA yourself, that the total amount of money that's going in there for the year, including what you put in and what the district puts in, is less than the limit. The limit that Stephanie had on the slide, 4,400 for an individual, and I think it's what, 8,000.
750.
Yeah,
For next year.
8,750 for a family. So you don't want to put in more than that.
Mhm.
Cool.
How about
Okay.
how about some raised hand? How about Daniel? Hi, Daniel. Daniel Hill.
Hello,
Hi.
can you hear me?
Yeah.
Okay, so I just put it in the chat too. Two questions. Basically, if the family deductible is met before each individual in the high deductible health plan, the payments stop at that point.
Yes.
Okay, and then also with the current FSA I use, basically I say I'm going to pay. I always do the max because I have 4 kids, and then on January 1, all that money's available, even though they haven't pulled it. It will be available. Now on the FSA, I know you said there's
Yes.
the February 2026 contribution.
Yes.
So let's say I tell payroll, hey, I want to pull the same amount. Is that all available January 1, or is it a month by month as it builds up?
Unfortunately, with the HSA, it's month by month.
Okay, but if I said, hey, I want to have the full amount in there plus the district's money, and just move that there, I could do that January 1 if I wanted to.
You can do that January 1 too on your own through Fidelity.
Perfect, thank you.
Hey, Stephanie, we have a couple of, there's been a couple of questions about qualifying events, specifically if a dependent who is not currently, if people have their own insurances, one person becomes a dependent mid-year, could you put them on your insurance?
So the qualifying events on when you sign up, when you get a plan, like to be, is that what the question is? When can you change your plan or add people to your plan? Is that?
Yeah, so it's like qualifying events, we know it's like divorce, death, marriage,
Losing
birth of a
changing
child.
jobs.
But if you're a dependent who is not on your insurance suddenly needs to go on your insurance mid-year, would that be a qualifying event?
I'm not too sure about that. That would be a
Pretty
benefit.
sure that it is. I was just
Yeah.
looking it up.
Okay.
For a dependent, but what I haven't confirmed yet is whether a spouse who had a change in their insurance situation, like the example provided in the chat was a spouse who loses their job and loses their insurance that they get through that job.
Yeah,
That
they're considered dependent though, right?
Yeah.
Includes insurance.
Oh, is a spouse considered a dependent?
Technically, yeah.
Oh, okay. I'm sorry. I didn't realize that was the same category. Okay.
Yeah,
Yeah, but I would email Nicole Keller in HR. If I really can't figure something out, I always ask her. She's terse, but usually accurate.
Mhm. To the point. She's to the point.
Yeah, exactly, which is nice.
Yeah. Loretta.
I've been trying to put in the chat and I know Rebecca's trying to answer, but I'm confused when you had on slide 14, you were showing the comparison between the Kaiser, regular HMO and what I understood is the high deductible, but I guess it's DHMO on slide 4. I didn't understand how the premium cost was $253.20 when according to slide 4, the DHMO is
No, this is high
$650 a month.
deductible. This
That's
we
what I was
don't
trying to
have
understand.
we don't have DMHO on here. We only did HMO and high deductible.
Okay, I guess that's what I was trying to understand when I was looking at, okay, when you have the HMO and then the DHMO, which is Kaiser's high deductible. That's different.
No, it's not. No, the DHMO is not Kaiser's. Kaiser has its own high deductible. Kaiser has 3 plans: HMO, DHMO, and high deductible.
Okay, so the one you show on slide 4 is the DHMO, which you haven't
the HMO
shared.
and the DHMO are on there.
Yes.
Oh, is it? I didn't
Yes.
see it.
Yeah.
Okay.
It's at the bottom.
If you go to slide 4, yeah, it's at the top and the bottom.
So Loretta,
I'm not seeing it.
it's
At the
slide
bottom.
It's
Right
on the screen.
11 that has the Kaiser high deductible plan. And slide 4 has the Kaiser DHMO, which is an HMO plan that has a deductible, but it's not a high deductible. So the Kaiser DHMO is a different version of the Kaiser HMO. It does not qualify for the HSA.
No.
Okay.
If you look at the screen here, you have the HMO and the DHMO for Kaiser, and the HMO is more expensive because
Right.
you just there's larger copays and other things that you have to pay for on the DHMO that you don't on the HMO. So you're paying less in your premium, but more in your like day-to-day costs.
Mm-hmm.
But if you
Okay.
switch to the high deductible, it's still way better, just
Okay.
financially.
That part of it. Okay. All
Yeah.
right. Thank you.
Yeah. And I think the reason we don't cover it is that it's like there's just not many people on it.
No, not very many people at all.
But one of us can
Just trying to,
down
just trying to figure out the cost of it. So yeah, the HSA, I'm not eligible to do. And so I'm trying to figure out what's the better overall.
Well, if you want an HMO, I mean, the best in terms of money is WHA.
But you can still do the high deductible even if you're not qualified for the HSA. So you can still do the high deductible and only pay $253. You're just going to be paying out of pocket until you meet the high deductible, which is 20 for individuals, 26, 34, and 52.
Okay, so the deductible, other in this slide, sorry, the $5,200 for family, and then the out-of-pocket is $5,550. So I would add both of those plus the premium cost.
No, that means once you meet the deductible of $5,200, the most you can pay is an additional $350 more.
Okay. Okay, thank you.
You're welcome. Orny.
Thank you. I need to tell everyone that if you're close to retirement, you should see someone about this. I just spoke with a Medicare specialist, Jim Meher, who came to the LRCFT Medicare workshop and gave a workshop on this. And there are a lot of nuances that they didn't mention at the workshop. And there are just so many fine print that information that you really need to be careful about this. I know this because I'm considering retiring, and there's a number to call. There's an email address to send to, and Jim has been in this business for I think over 30 years, and his staff has been really good too. I just called this afternoon before this workshop. Thank you.
Thanks, Marnie. Maria.
Yes, hi, thank you. I also had a question. You know, I'm over 65, and Katie, I think you mentioned there was, you know, something about if you qualify for Medicare, which I do, but I'm not on it. You know, I don't know even how to apply for it, but you know, I don't want to mess up my Kaiser insurance by doing anything like that. So would I have to have additional information, or if I haven't even, you know, been involved with Medicare yet, and I'm still entirely with my Kaiser HMO, can I still switch over to the high deductible plan?
So I'm going to read you what this says, what I'm looking at. Once you enroll in Medicare Part A and or B, you can no longer set up or contribute pre-tax dollars to an existing HSA. This is because to contribute pre-tax dollars to an HSA, you cannot have any health insurance other than a high deductible plan. So you could double check with Nicole Keller to see, but if you're not actually enrolled in Medicare and you're not
I'd have to
actually,
check and see if anybody's automatically enrolled me because,
well, that's whether you're enrolled or not, you need to check with Nicole, I would say.
yes, okay. And what was her name again?
Nicole Keller.
Nicole Keller at District?
At District, yeah.
I
Okay,
would
Nicole
say
Keller.
that you are required to sign up for Medicare at least 3 months before the month that you turn 65, something I'm discovering in my own life.
You're required to sign up for it, or you are not?
Yes, you are.
You are. So that's what in the back of my mind, I kind of remember something like that.
Yeah.
I didn't want to be, but I kind of am wondering if maybe, you know,
Well,
I
there's
am
other
anyway.
Yeah, there's
So-
other plans that you can do. To be honest, I'm looking, my wife is approaching that. And so I'll be looking into it. Once I know more, we can, because I know there's a lot of people in your situation. We'll try to have another workshop just like on specific
Okay,
stuff.
yeah.
Also, the district doesn't have their retiree benefits out for 2026 yet either. So it's like, we
Okay.
just have to wait a hair. Okay.
Okay, yeah. I don't want to, you know, shake my boat in any way because I like things the way they are, but I really do like the idea of the high deductible plan if I could get into it, but I don't want to mess things up with, you know, having to change entirely to something different as far as my doctors go and all that.
Yeah. Well,
Okay.
you don't have to change your doctors if if you're within the same carrier. That doesn't change. If you go from an HMO to a high deductible, it's all an HMO. It's just
Yes.
you pay for it is different.
Yes, and that's what I would love to do, but I'm wondering if Medicare would interfere with that. If I've been enrolled in Medicare, like not against my will, but I didn't ask for it.
Well, so the thing is, you could still be in the high deductible plan, just not have an HSA account.
Oh, okay. So I could just still pay out of pocket and not contribute to that to the
Yeah.
account.
So yeah, you could still have a high deductible plan and not have an HSA account.
Oh, okay. That's much better. Thank you.
The high deductible plan comes with the benefit of having an HSA account.
Yes.
But if you're on a high deductible plan, you cannot have an FSA account. So
all right. Okay, I get it. Okay. Thank you so much.
Yeah, you're welcome, Maria.
All right.
I will say that retirement, and I'm assuming going on Medicare, but I have to double check that, would be qualifying events. Retirement is definitely a qualifying event. You can change mid-year.
Orny.
Okay, sorry to say this, but because I am considering retiring, I have done a lot of research on this. So Maria, I would say you definitely need to reach out to HR. No, you do not have to sign up for Medicare when you're still working when you're still working. So you do not have to sign up, but you should talk with HR. You can sign
Okay.
up for Medicare when you retire, 3 months before you
Okay.
retire.
But yeah, I would think that it would be a voluntary thing, you know, I don't want it yet.
Mhm.
Right,
Because
when
I
you
don't want to
work
mess up
actively,
things
you
like
don't have to
this.
sign up for Medicare. But when
Okay.
you, a few months before you retire, I don't remember how many months, please look at the link that I put in the website, in the chat.
Yeah.
It's
Okay.
really a lot of fine print. So please do that because I spend so much time on this. I still have questions. Thank you.
Yeah,
Yes.
the retirement
Very-
part that the district hasn't given us the information really puts a wrench into open enrollment for our employees who are close to retirement. And so the district stalling on this is not good. Is not good. And but open enrollment is open until the end of the month. And as soon as I do hear from the district that the information for retirees is available, I will send out an email to everybody.
Thank you so much. Yeah, I would like to clear all of that up. I'm not thinking of retiring soon, but I am over 65 and things are starting to get a little bit different.
Yeah,
You know, as far as my insurance coverage, I expect it to be because of Medicare.
yeah.
Okay, thank you so much. I will definitely call HR and get further clarification.
Thanks, Maria.
Thank you.
Rebecca, do we have any other questions that
Oh,
were
yes,
from
we
the chat?
do.
Oh, yes, we do. Okay.
All right, if someone is under a high deductible health plan from their spouse, can they have an HSA through this school?
If somebody is on a high deductible plan through their spouse, then they are considered, because they're married, to be on a family high deductible plan. And so their spouse probably has an HSA through their employer then, is my interpretation of what's being said. So if that person wanted to just stay on their spouse's coverage and get the $100 from declining the coverage from the district, then they're not going to be eligible to open the HSA through the district and get the district contribution to it because they don't have health insurance coverage through the district. Does that answer the question though?
Yeah, I don't think you can have two separate HSA accounts if there's only one high deductible plan.
No, you can, but you can, but you're like basically you don't get double the limit. The limit is still that limit for those two people.
Yeah.
So like I'm not sure if I fully get what the person's question is, but like if I wanted to if two people are married, they have family coverage, they could each open their own HSA if they want to and each put half in it as long as the total amount is less than the IRS limit for family coverage, but there's no reason to do that for like a normal situation. So I'm not sure, like, I think what this person is asking is they already have high deductible plan coverage through their spouse. Can they open an HSA through the district
So they can get the
and
benefit.
get the $1,500? And I think that that's probably what this question is. And the answer to that is no.
Yeah.
Not if you're declining health coverage through the district. But if you're on that district's high deductible plan yourself and you enroll in it, then you would get it.
Gordon, you can pick it when you retire. That's a qualifying event, so you can do it mid-year.
How about Stuart? Hi, Stuart. Oh, you're on. Yeah.
Hi. Hi there. So both of my wife and I work here at City College. And of course, if the Kaiser, we both belong to Kaiser, and if the Kaiser premium goes up to $1,200 and something, that's almost $25,000 a year for us. This is very interesting to me. So if we set up an HDHP, am I right in assuming that the district will pay $1,602 a month for each of us.
So
And
why would you both have your own coverage when you only need one and it covers for a family?
well, that's what I'm asking.
So
With-
it's when you enroll, and if you're married, one of you would opt out of coverage and be on the other person's plan.
Okay, so since we both work for Los Rios,
Yeah.
we would only make the one 1,600, or the district would make the one $1,602 contribution a
Yeah,
month.
because you only pay for one plan, and the other person opts out and gets $100 a month for opting out of medical insurance.
Okay, all right.
So yeah, so because it's a family, you don't pay more for family or single, so there's no reason for both of you to be paying for insurance.
Right, and as you guys just pointed out, there's no reason or little reason to have two separate HSA accounts. It'd be just best to have one up to the
Yeah.
maximum.
Yep.
Okay,
Yeah.
thank you.
Yeah.
Okay,
it says if you're both in Los Rios, I thought you couldn't get the $100 opt-out. Is that true?
No.
no, you can.
Okay.
Yeah. Bill and Robin do it. Mhm.
Okay.
Yeah, Susan and I did it for like a year. You have to fill out a form and it's kind of annoying, but yeah.
Can I quickly jump in on that?
Yeah.
And I apologize, I am not a faculty, but my wife is, and I'm on her plan. I'm classified.
Okay.
I could have sworn I've been told I can't opt out, or I can't get the $100 because my plan is still a Los Rios plan, even though it's through her. Could it just be because it's classified faculty combo situation, or am I just understanding that wrong?
I don't know that.
Well, it is a complication because we're just talking about two people who are in the faculty bucket, but you should be able to opt out whether or not they give you the $100 anyway because you're on her plan.
Well, yeah, I opt out every time, but it was the $100 part I was.
That might
wondering
be just a faculty benefit. I'm not sure
about. Okay,
though.
thanks.
Yeah, we have a better deal than classified and admin in terms of how much we pay, which is like cool and unfair at the same time.
I mean, I save more than the $100 by doing it through her.
Exactly.
So yeah, I get that. Thank you.
Yeah, no worries. I have a question here. If someone has an FSA now and they want to switch to an HSA, what do they have to do?
So you can only have an HSA if you have a high deductible plan. The FSA is for traditional HMOs. So it depends on what type of plan you have. So if this year you're on a traditional HMO, you have an FSA. If you at open enrollment, you switch to a high deductible, then next year you would have an HSA. And your FSA is only 1 year at a time anyways. And so you use your benefits up this year. You have until March I think it's March 15th or something, or March 31st to spend your money from last year. And then it goes away. But you can't, you cannot have an HSA if you are on a traditional HMO. You can only have an HSA if you're on a high deductible.
Okay. So thank you. I asked the question.
Oh, hi, Jeanette.
Hi.
Hi.
Because so I want to switch. Like if I'm thinking about switching,
yeah,
and I want to get that $1,500, in my HSA, will that count for next year if I change my enrollment this year?
Yep.
For next year?
Yeah. So open enrollment affects
Yes.
affects next year. So,
perfect. Okay.
So during open enrollment, if you sign up for a high deductible plan, and make sure you enroll in the HSA account before year end,
okay,
and then you will get the $1,500.
Okay. Great, thank you.
You're welcome, Jeanette. Oh, Jeanette, I love Jeanette. What else do we have, Rebecca?
Okay. If someone has an HSA and they get the $1,500 in there, but they're also contributing monthly, do they have to make sure they don't go over the IRS maximum, or will it be obvious in their account, or like, do they have to be the guardrails?
Yes, you be the so.
Okay.
If you're going to log on to Fidelity by yourself and put money in there, You need
No,
to make sure that you
no,
don't
they
put in
need,
too much.
right, they mean.
And payroll deductions, and your payroll deductions, you have to,
Okay,
so you
right.
need, yes, you need to be the guardrail.
When you go on to sign up for benefits and you're enrolling in the high deductible health plan and the HSA, it's going to ask you how much you want to put in per year. Don't type in an amount that's more than the limit.
Mhm. Yeah.
I don't know what would happen if you did, if the website would fix it,
There's
or
probably a
if it,
penalty, or they might just send you a check back. Hopefully, I don't know.
no.
No.
I'm so when you're on Los Rios Benefits Super site enrolling, it's going to be like you're enrolling in the HSA, and there's going to be a box where you're going to type in a number that is going to be like the amount you want to contribute through payroll for the year, and then it divides it up and like contributes it. Like I typed in $1,000 and it's taking out $83 12 times, I guess. So when you type in that amount, like don't type in like $10,000 or some amount that's over the IRS limit. Type in the amount that is the IRS limit or a lower amount, and then that way that you wouldn't. Am I misunderstanding?
No, yeah, so
Yeah,
you have to be the guardrail, so you have to know what the limit is. Subtract and add, make sure you add the 1,500, or if you're on WHA, add the 1,800 or the 1,200. So you know that, so if you're on WHA, already being contributed to your plan is $3,700 or $2,700. So you can only contribute another, I think the maximum is 4,400. So 44 minus 27. So you can only contribute like another, right? And so 15 plus 12 is 27. Yeah. Minus 44. So you can only contribute another $1,700. So you don't want to put more than $1,700 in that box. Now,
Right.
does Fidelity, would Fidelity stop money coming in? I don't know. I've never gone over the limit. So I know
So when you're on their website, though, if you go on to Fidelity and you click to contribute to HSA, it shows you the limit. It's like, reminder, this is the limit. And then it shows you like how much has been put in so far that year, but they don't know how much it is your employer going to put in the rest of the year.
Yeah.
So it will let you on fidelity.com put in the total amount that's left, even if your employer is going to then put in more. I don't think it's easy to avoid doing that. And so I think me and Stephanie have just not done that. So we don't know what's going to happen, but it's not good what's going to happen.
Yeah.
And I don't get the impression that it will be easy to fix because just because of some of the stuff that I've seen on there. So
the cool thing about the HSA compared to the FSA, you put in a dollar amount at open enrollment and it's set in stone. You cannot add, you can't decrease. The HSA, you can actually stop mid-year. So if you accidentally put too much dollar amount in that box and you realize you're coming actually close to that limit, you can actually go to HR, fill out a form, and it'll stop your HSA payments for and actually I think you could do it on the super site. You don't even have to fill out a form anymore. Before it used to be in paper, but now you can go on the super site mid-year and stop making HSA payments. Or if you didn't put in HSA pre-tax money at open enrollment, you can start it any time during the year. So that's the one benefit also that's different with the HSA than the FSA, is that you're not limited just to open enrollment to start or stop. Heike.
And I apologize if this was covered already just now. So I've been with the high deductible plan for a couple of years, I think now. And I always say it's the best thing I've ever done while in Los Rios for medical insurance. But the $1,500 and I think I know, and Rebecca, I know I asked you this in the chat and you said you would check, but since it's now clear that it sounds like the $1,500 are being put into the HSA and not just onto our paycheck.
No. No paycheck,
Yeah,
HSA
yeah,
account.
yeah. But what I'm saying is that means I have to change my contribution because otherwise I will be over the limit. So I have to figure out how to
Yes.
do that in the super side, I guess. Yeah. Okay.
Yes.
Thank you.
Yeah,
I
so
just
if
wanted
you're
to
if you're
triple
an
check.
individual,
Yes.
next year in 2006, the most you can contribute is 4,400.
Yeah,
So if
I
you're
saw
getting
that.
the 1,500, that means the most you can contribute is 2,900.
Right.
So when you do open enrollment this year, do not put more than 2,900.
Right. Okay, will do. Thank you.
Mhm,
I just want to triple check things.
Yeah, no problem. Because like Katie and I said, we don't know what the bad would happen, but it's bad. We just know it would be bad.
Yeah.
I don't know what it is. I've never broken that rule. I don't know if anybody has broken that rule and what happened, but the IRS does not like if you go over that limit.
Right. I also wanted to share, I don't know if this is, you know, applicable to anybody, but I asked, and I can't remember if I actually reached out to Fidelity or somebody. What if one can do this if one retires maybe abroad, right? And they said you can still use the HSA money for medical stuff in another country.
Wonderful.
Yeah.
Yeah. Yeah, the HSA account after you retire, that extra benefit of money is to be able to use towards medical expenses as an additional benefit.
Yeah.
Which is why sometimes it's good to put more money into the HSA account than you might use in 1 year, is so that way you can kind of have a little bit of a savings when you retire.
Yep.
That could be towards medical expenses.
Yeah.
Okay, so a related question. I think someone said, let's say they have they go to a high deductible plan, they get an HSA, they put money in it, and then sometime in the future they switch back to an HMO. Can they use that HSA money to cover premiums or just co-pays and other expenses?
So if you look at a bunch of stuff from the IRS, it's basically, there's very limited circumstances where you can use HSA money to cover health insurance premiums. It says like COBRA, if you lost your job, maybe, and it says you can use it to pay for Medicare premiums, even though you can't put money in it anymore when you're covered by Medicare. But you can't just use it to pay for regular health insurance premiums. If I was going to try to use my HSA to pay for any kind of thing like that, I would look very, very carefully at the IRS website and talk to some kind of tax advisor before I did that. Because if it's just regular health insurance premiums and not one of those special things, then no, you cannot use it for that. Right, Stephanie?
Yeah, but and the question also about copays. So could you pay for
Yeah,
copays?
you can use the copays. Yeah. Yes. Copays, anything, but not premiums.
Not premiums.
Gotcha. That's awesome. Someone's worried about certain kinds of drugs being covered under a high deductible plan.
It's the same as a traditional HMO.
Okay, cool.
Where
Yeah, so
you're not you're an it's still an HMO. It's just how the coverage isn't different. It's just how you pay for it.
all the drugs that the HMO would cover will be covered by the high deductible plan under the same provider. So if you were on like Sutter HMO and you switch to Sutter high deductible plan, they have the same formulary list of the same medications that they cover. But you might have to pay out of pocket, until you meet the deductible for those drugs if they're not preventative.
Yeah, okay. I think we've covered this a lot, but just in case people are still confused. If you have a high deductible plan, you do not have to have an HSA, but why wouldn't you want one?
Well, you wouldn't want one if you were ineligible by
Well,
law
sure.
to make
Well, you might still-
contributions to it.
You might still want one though, right? Okay.
And also you might not want one if you maybe you just were like, you know what, I only go to the doctor once a year. It's preventative. I literally have no medical costs. I don't want to deal with an HSA, so I just won't have one.
Sure.
Those are the reasons.
Well, I mean, you might get that 1,500, but yeah.
But yeah.
Okay, let's see here. There's someone who is talking about best provider for chronic illness. I think this for me is about preference. I like Sutter. They work for me. I don't want to switch, even though it's financially better if I switch to WHA or Kaiser high deductible plans. I don't want to switch from Kaiser. So I'm taking my first plunge into the high deductible landscape this year to Sutter. They all should be able to treat the chronic diseases fine. It's just, I think, more about preference. Any other thoughts on that, you two?
Yeah, I mean, the only reason why, I've been Sutter high deductible and for years, and the only reason why I'm not going to switch to Western Health this year, I will next year, is because I had cancer, and I have one more year with my oncologist, and I don't want to lose my oncologist. So that's the only reason why I'm going to stay on Sutter, is because of I have my, yes, would I be able to find another oncologist with Western Health? I'm sure I would. Would they be just as great? Probably. But I've just been with this doctor for the last 5 years, and so I don't want to lose my doctor because they're, but now some Sutter doctors are covered under Western Health, but not all. You have to go onto Western Health's website, and you can even, you can go on their website now as not a member and see which doctors are covered. But some Sutter doctors are covered by Western Health. So, because Western Health is more like a Blue Shield, Blue Cross, or Anthem, where they go to, UC Davis. They have UC Davis doctors. They have Sutter doctors. They have Mercy Health doctors. So they have doctors in all the different, hospitals. That's what Western Health is. Kaiser is just Kaiser doctors. Sutter is just Sutter doctors. But Western Health is basically one of those general plans that have doctors in many different hospitals.
Okay, you want to answer the chat?
The chat, I don't even know how to do the chat right
Okay, my
Doing it
husband is
from
on my healthcare plan, but he does have Medicare Part A. Does that disqualify me from getting an HSA if I have a family HDHP?
I think so. I don't. Now it's so that's a little bit more of the nuances.
I think if you are not on Medicare, you should be able to get a high deductible HSA combo.
So everybody, I put this link in the chat that this is like this IRS tutorial about HSAs and HSA high deductible plans. And if you go through it, it goes through like all these really detailed scenarios. That it just might be helpful to some people who have questions, especially if you're married and you're trying to like work out with another person whether you're eligible or how the contributions will work. You might want to try going through it and see if maybe some of the information in there helps you. But also Nicole Keller should be able to answer these questions, I think, right?
Yeah.
I would think so. That's her job.
All right, someone is asking about the WHA HMO to HDHP transition, and I would say yes, because you're going to get $1,500 now, and you're going to get $1,500 next year, and with the WHA, you're going to get $100 or $150 a month on top of that. So it's like, if you're looking at just pure finances, the WHA high deductible plan is the most awesome currently.
Yeah.
Period. Yeah. Okay, a couple of random questions. I'm assuming we're not going to do any double coverage stuff because none of us get it. Talk to Nicole Keller, please. Someone asked if the negotiated rates are published anywhere, and I would say we just went through them. Is that true, Stephanie?
Are the negotiated rates?
No,
Yeah.
no. The negotiated rates, what
No.
that
Oh,
are,
you mean for individual things?
yeah, you can get a sample list of the negotiated rates from the district website. It's not that obvious, like how to get to it, but the one for Sutter is called estimated costs, and it's supposed to show in it like these cost estimates for different services. I just got it in person the other day from the health insurance fair, but I don't know where it is on the website. But they have a list of like what is the negotiated cost you would pay before you met the deductible. and it's somewhere. Stephanie, do you know where it is?
No, I know, no, the district makes certain things hard to find. But so they
Yeah.
were at the health fairs,
Yeah, they had a big stack of them. So it's on here somewhere. I just don't know exactly where they have put it.
Yeah.
Can I ask that person to email one of us and we'll figure it out?
Yeah, we can, yeah, please do.
Yeah, I'll email you because that's a pretty important decision-making factor.
It is, and yeah, it really is, you know, especially if you're a family, because, you know, if you're an individual and getting that $1,500 in February, that basically pays for your health care. And so you're not, it's not a problem. But if you're a family, then yeah, you have lots of, if you have lots of medical issues right at the beginning of the year, it could be an issue.
Okay.
Alexander.
Hello, thank you very much for the information. I actually have, all my questions are kind of have been answered in the process of this workshop, but I wanted to ask you more specifically about those negotiated rates. Will Kaiser, if I call Kaiser member services, will they tell me what those negotiated rates are before I meet the deductible?
So in my experience, they will tell you, but they are going to say that they can't guarantee the amount you will pay for any specific thing because it kind of depends on how the doctor bills it. So like if you call them and you're like, I'm going to the doctor, how much will it be? They're not going to be able to tell you because the doctor might bill it as like a higher level visit or something depending on what happens. So it's like a list of sample rates. It's not guaranteed. So like if you look at this one in the chat, thank you, Shannon, for putting that. This is exactly what I was talking about, the Sutter sample fee list. Like the first thing on it is doctor's visits, and they have low level visit, low to moderate visit, moderate to high level visit, and high level visit. And you're not going to know whether your doctor's visit is a moderate visit or a low to moderate visit until after you're done with that appointment, because it's going to depend on how the doctor determines what you've said is basically. And so like on here, low level visit is $104 and moderate level visit is $253. And these are this is an old sheet. This is like 2019. But they had an updated one. I know there's an updated one because I saw it 2 days ago. But that's the thing. You can't be sure exactly what the cost will be, even if you call them, because they can't know exactly how the doctor will bill it.
But all this will count towards my family out-of-pocket maximum, and after that, that's not going to be relevant anymore, right?
Yes. With Kaiser, with Kaiser and Sutter. Well, actually, all of them, yeah.
Well, there's a small out of pocket that's different, but it's rare. It's for like the
So once you meet your deductible, then on Sutter and Kaiser, you're just paying the hospital admission. Western Health, you're just paying copays for your prescriptions. Yeah, like I said, I literally had 2 surgeries for free. 2 surgeries, and because I met my deductible.
Right.
And MRIs and CT scans, like real expensive stuff, I paid $0. Mm-hmm.
And let's say you think you might have a year where you're going to be in and out of the hospital, like you might have some kind of health issue that might happen. You can sign up for Voya, which has a hospital indemnity option that's pretty affordable. And you can get money back if you're put into the hospital often. So that's another one of the benefits on the employee side. That's for some of those rare cases.
And just one last question. So is this webinar is being recorded, and also is there a transcript of the chat? Will it be available to all of us, to all the participants, or?
Okay, so I think Katie said earlier you can save chat. So I'm not going to send you the chat. I'll send you the video, which will have transcripts. If you look at the top of the chat screen right now and you hit those 3 little dots that are side by side, it says save chat. I'm assuming it will. Okay, I saved it. Haha, I can send it to you.
Okay, I did that as well, but if you can.
Oh, that's cool. I didn't know.
I don't know. I've never done that before, so thank you.
But yes, we are recording this, and it's going to be posted on the LRCFT website.
Okay, on the union website. Okay, got it.
Yeah, this is a union event, so it's on the union website.
Okay, and then I think one final question, are there any plans to negotiate help for part-time faculty? I think we've done that a lot already, but
Can you repeat the question?
are there any plans to negotiate help for part-time faculty?
In what sense? I don't.
I don't know. I'm assuming it's that they think the rates should be lower.
So a faculty member is a faculty member. So if you're part-time or not, unfortunately, there's no differentiation. You know, even if you worked part-time at a regular company in corporate world, you're still paying the same rate as a full-time employee. So there's no way to differentiate a rate just because of how much you work. So a part-time employee and a full-time employee are going to pay the same rates. The only thing that's different, so unfortunately that's we don't have a difference with that.
And it is better than it has been because it is reimbursed now, unlike in the past. So yeah, something that I think people are want to work on is trying to get the HSA contributions for.
That's what we're working on in contract negotiations.
So, but you know, so it's on our radar.
On our radar.
Yeah,
try to make it better.
Okay, I think there's hands up.
So I don't know if Alex, you still have your hand up, but Heike, do you have another comment?
Just a quick comment, and I don't know if you already, Stephanie, you may have mentioned this because I know you mentioned this in another last year or something, that just to assure people with the, you know, maybe not being able to have all this money ready in February when you have a big expense, that Kaiser for sure, and I'm sure Sutter, they do payment plans. So they often send me this email saying, well, if you can't pay, it's like, well, I don't really have to. Anyway, they sent this out just to remind people, right? So that you can reach out to them and negotiate payment plans. You don't have to fork out the money all at once. Is what
exactly. When you get a medical bill, you don't have to pay I know Sutter does because I've done it before. That's how I would pay for my medical plan, my medical bills until my contributions and my HSA caught up. Is basically I would just go on a payment plan and it would just deduct from my HSA every single month until I met my deductible. So yes, you don't have to pay when you get a medical bill. The carriers will, you know, your health plan will negotiate. We'll have a program for you to make payment plans. Sometimes there's a little bit of a cost to it. They do charge a little bit of interest. I know Sutter did charge a little bit of interest, but they will do it so that way you don't have to pay. Oh, Oliver, sorry, that's my cat. There we go. You don't have to pay 100% right away. So if you do have $1,500 worth of bills in January, you can be on a payment plan and you know pay for it over time. Thanks, Heike, for reminding us.
Okay. Do you mind if we stop recording so that people, if they want to ask a question that's not on the record, they can? And okay, I'm gonna do that.
I'm gonna stop share too. Yeah.